And thank you all. We are here with Marc Foran, Chief Investment Officer for Rally Assets. Marc has over 2 decades of experience in the financial industry. He has diverse expertise in a broad range of experience being running multi-asset portfolios, as well as prior to being with Rally, he was a portfolio manager with the British Columbia Investment Management Corporation and managing their global thematic fund. So with that, thank you very much, Marc, for joining us today. We're looking forward to your presentation, and we really appreciate you sharing your insights with us. So I'm going to turn it over to you now.
Great. Well, thank you, John, for that kind introduction. And thank you to everybody at Finposium for attending this session. So I'll be talking to you today about impact investing and really focusing in on a few areas. So first, we'll talk a little bit about responsible investing and where impact fits within that ecosystem. And then from there, kind of juxtapose ESG, which, I think people are very familiar with the term, and ESG integration to impact. There's a lot of terms that swirl around in responsible investing. So hopefully we can add some clarity there. Talk to you a little bit then after that about the impact market and in Canada and how we approach things at Rally Assets. So we can get going. So first, a little bit about Rally Assets. We're an impact investment management firm and an advisory firm. We've been around for over 11 years, started as an advisory firm and added the investment management capabilities a few years ago. What's interesting is we've always done impact investing, and it's all we do today. And so it's really built right into our DNA. It's not that impact is a bolt-on addition to our firm. It is what we do. And our goal is to help investors generate a positive and social and environmental impact alongside a financial return. Now, how we do that is we create specialized solutions for accredited investors who our client base is. That includes institutions, foundations, endowments, family offices, and of course, accredited individuals. And as mentioned, it's really built into our DNA. We're a certified B Corp. So it's our firm's mission to deliver that impact and very consistent with our investment stuff. We offer a pretty diverse set of services, starting with the asset management side. We have 2 really core product offerings. The first is our Rally funds, 2 funds that we launched about 1.5 years ago. The first one being the Total Impact Fund. It's a really different type of fund. It's a global multi-asset class fund, but it goes beyond public equities and public bonds. We actually have private investments in there. And across that asset spectrum, it's 100% impact focused. And our second fund is our global equities product, which is a concentrated portfolio of active equity positions and high impact global opportunities. Our second offering on our asset management side is our managed accounts. And so those are for larger clients typically that want a very customized way to approach impact investing. So something that is more fitted to what it is they're trying to accomplish. We also offer our impact advisory services. Again, these have been around for over 11 years, and that's helping our diverse range of clients really develop and understand what their impact investing strategy should be. And of course, developing their approach and their theory of change to impact investing, which is quite important when knowing what is it you want to achieve in the world, what kind of impact is it you're looking to do. And Rally, of course, has been very active within education on impact investing, workshops, and has done extensive market research. And finally, always very important within impact investing is our impact measurement. We certainly do that for our Rally funds and managed accounts, but we also offer services for clients that really want to understand the impact of their current portfolio, as it's something that may not be obvious and clear. So now I'm going to talk to you a little bit about responsible investing and talk to you about what that ecosystem looks like and where impact really fits in. So what you see on the screen here in the box is what we would call the ecosystem of responsible investing. And I'm sure a lot of the terms are familiar, and interestingly, a lot of terms get interchanged almost seamlessly, but there are quite distinct differences. So starting on the left, and that's typically screening as in negative screening or avoidance, that's sort of the shallow end of the pool, if you will, for responsible investing. And then going towards the right gets deeper in terms of impact, right all the way till the deep end of the pool, which is what we would define as impact investing. The market, this is the global market in terms of assets under management for responsible investing as a broad category. And you can see back in 2006 wasn't very big, although that is in trillions of dollars. Hard to believe that trillions is no longer considered a big number, but on a global perspective, it's actually quite small. And it's grown tremendously. In recent years, since about 2014, that's a compounded annual growth rate in AUM of about just under 15%. Canada has been a little bit behind typically on the impact investing spectrum, but quite participating strongly within responsible investing. And in fact, has experienced growth faster than the global market in terms of assets under management over the past couple of years. And that's 48% in total, or about just a little under a 22% CAGR. So the big question that I would say I get asked often about in impact investing is, what is it? People hear the term, but they're not really sure what it means. And frankly, all investments, be it positive or negative, have an impact. Sometimes it's an intentional impact, and sometimes it's not. So in impact investing, what you're really doing with intention is looking to generate a positive, so on the positive side of impact, a social and environmental impact, but also alongside a financial return. It's not impact investing simply for the impact. Both are required. There is a return element. Now, juxtaposing ESG or ESG integration with impact is something that's important because it's very much a difference in perspective that an investor would approach this with. So in the case of ESG integration, an investor typically looks at their company first, as a bottom-up analysis, and then kind of understands through ESG analysis the impact of the world along those factors on the business itself. So it's a very shareholder-centric or primacy kind of view. Impact investing takes that equation and kind of flips it on its head and says, rather than looking at what the world is doing to the company, what is the company doing for the world? And it might seem like subtleties in terms of difference, but actually you end up getting quite a very different perspective in terms of an opportunity set. And again, with intentionality, identifying upfront those investments that are going to deliver very high impact. And that impact isn't just across shareholders, it's across multiple stakeholders. And so what do I mean by that? So moving away from shareholder primacy to multiple stakeholders means, as an investor, even though you are taking the seat of a shareholder, you're considering and wanting to understand that impact across many. And that would be, in addition to shareholders, the employees of the firm, the suppliers of the firm. So both those very much in terms of how the operations of that business conducts itself, the community in which that business runs, society at large, what contributions are being made, and of course to the natural environment and to the climate. And so that means when evaluating impact, you have to ask yourself a lot of upfront questions when you're evaluating a potential investment. Who is being affected by a particular change that a company is affecting, be it positive or negative? What is the degree of change? What's the materiality of it? How significant will it be? What is the time period? Is it a change that's going to take a tremendous amount of time and thus not be very well felt? Think about, like, goal 2100, by year 2100, zero carbon. That seems like a long time when you see objectives like that. Influence. Is it going to make a change. And is that change going to be significant, and will it last? Or is it going to be a temporary effect? Also looking at the risk. So there's a risk with not making impact investments. If you don't do this, society and the environment may not be positively impacted. And so there's actually an inaction risk that one considers. And then, of course, how that change is made, looking at all the elements of how a business conducts itself towards achieving that impact. And so, looking again about the approaches between ESG and impact, what you see on the screen right now are on the left, an impact approach to investing, and on the right, an ESG approach. Now, I would say this is a traditional ESG approach or ESG integration approach. And the key difference is the very first question you ask yourself as an impact investor is to screen and to look at impact as your criteria for selecting potential securities that you'll examine, and then do your fundamental analysis. And of course, continue to understand that impact. So it's right at the front. Versus an ESG approach really looks at a company, does a traditional financial analysis, traditional due diligence, and then from there, kind of does what I would say is an ESG screen. Often in firms that might look like a separate department that comes in to weigh in on an investment and to see, is this investment suitable, or is there any risk there involved with an investment from an ESG standpoint? If the answer is no, that investment may proceed. It may create a societal benefit, or it may not. So where that impact and ESG lens comes into an investment process really leads to a very different outcome in terms of portfolio. Okay, so now I'm going to talk to you a little bit about the impact investing sector. So before I showed you a chart of the assets under management of responsible investing, what you see up here, and this is in billions of dollars, is impact investing. So considerably smaller, but growing at a much, much faster rate. We're talking about 40% type CAGR since 2014. And you can see that it's really accelerating. So it's not petering. If anything, we're right at the beginning of what I would say is an explosive growth time. Canada's market for impact investing is still relatively small at just 20 billion, but again, growing very, very quickly. And if we look at what's in the Canadian market, and investors, although it's not limited to private equity, often think about private equity and private funds in terms of the impact that they can create. Canada's been relatively narrow in terms of the areas of impact that we focused on. And the blue bars are impact by different sectors. So on the left, affordable housing, healthcare, and food and agriculture for the general population. And so that alongside, I would also add, call it renewables or clean tech has really been the focus, but there's many more areas of impact. And we're starting to see development of new product in those areas. So we think that's going to develop over time, but to date it's been quite narrow. The orange bars that you see on the screen are impact in the same, call it sectors or outcomes that are looking to be achieved, but doing so for those that are part of marginalized populations. So think of diversity and inclusion, and considering those areas when delivering impact and really targeting that. So equitization of citizens. And what's interesting is we're seeing that across the entire spectrum. So it's small today, but it will be growing over time. So we're really at an inflection point where we expect to see over the next 5 to 10 years, even bars across many of the areas of impact. Some of the trends that we're seeing in the industry, of course, is ESG integration. It's kind of become table stakes. It's really a minimum requirement for portfolio managers today. Almost everyone says that they do ESG integration. So it was a new thing decades ago, and now it's kind of just what everybody does. Climate reporting too has become more of an operational requirement for companies rather than being a differentiator. And we're seeing a lot of evidence of that in the EU, and believe that other regions are going to continue to follow that, especially as the issues become more paramount. And from a client perspective, and this is where we see the biggest change, it's really amongst the clients. that are really looking to understand the positive and negative impacts of their investments. Now, it's kind of interesting how people, when they go and buy a food product, look at the ingredients list and understand what their food tastes like, but wants to know what's really in there. Is it good for them? It's the same thing happening now in portfolios. People say, well, there's supposed to be a positive outcome from what it is that I'm investing in, but what's really in there? What is it that I really own? And so issues that we hear about, such as greenwashing or impact washing, which essentially is labeling an investment green or impact when arguably it would not be considered that, is an issue that people are getting very concerned with and becoming front of mind. So the need for authentic and genuine product, and certainly the demand for it, is increasing. From a population subset, who's really driving the charge for impact investing? And what you see on the screen here is surveys for interest in impact investing since 2015. And the dark blue bar is for all ages. So that's everyone. And positively, it's going up, and that's great. Everybody's interested, and more so in impact investing. But where you're seeing really big change and a lot of interest is in the younger cohorts. So the light blue bar shows this for millennials, but if you go down successive generations to Generation Z and next generation coming up, everybody is thinking about impact investing. And eventually, over time, that means all of society will have this as first and foremost as a key area to focus on when investing. And we really expect that growth in impact and the demand for impact to be generated from a few macro factors, if you will. So one, I think we've all heard about the boomers are aging and retiring, and there's going to be a big international transfer of wealth. And when you think about who's getting the money, it's the decision makers, millennials and women, that frankly just invest differently. As shown on the previous screen, there's a greater demand for impact investing, and we think different choices are going to be made. There's been evidence to suggest that that's going to happen. Return expectations. Impact investing, for some reason, has long been considered as being charitable. Giving away money in order to create an impact, but that's not what it is. And if you look at the performance of impact investments, you can get market rate or even better returns through impact investing. Of course, if you want to do concessionary returns, there are products for that, if that's what you so choose to do, but that is not what impact investing is about. So as those return expectations improve, we think that's going to attract even more capital to impact investing. And of course, moving as people become aware of societal and environmental factors, increasingly, we all know they're there, but want to do something about that, there's going to be continued pressure from investors on their portfolio managers to get away from that stakeholder primacy-centric view and look at, or shareholder primacy view, I should say, and then look more holistically at all stakeholders and wanting to understand what the companies are doing and holding them accountable. And then finally, over time, we think that standardization of impact and responsible investing terminology and measurement will help reduce the greenwashing. So looking at the SDGs, or the Sustainable Development Goals, as a framework for impact investing is what we do at Rally. So we'll talk a little bit about our approach here. So I think many attending here today are familiar with the United Nations Sustainable Development Goals, but for those that aren't, they were developed in 2015, certified by 193 countries of the UN, which is a very large number. And there's 17 goals in total, and underneath them are actually about 162 or 163 very specific goals. And what they really do is outline the world's greatest needs for impact. So they serve as sort of a universal language that we can have a conversation on to understand what is the impact that's needed and what kind of outcomes are we looking to achieve and address. And it's very interesting when analyzing the SDGs, it's not a cost. It's actually an opportunity in many situations. So if you look at independent think tanks, 12 trillion in brand new opportunities, i.e. sectors that don't really exist today or are growing. Think of EVs and next generation manufacturing. 12 trillion is a big market opportunity for an investor. If you then think about investments in businesses that need to transform themselves, they aren't sustainable today, they need to improve, that opportunity is closer to 30 trillion. So it's a significant investment opportunity. If we want to conduct fundamental analysis, be it on data or identify things that businesses are doing from an impact standpoint, the SDGs serve as a great starting point, because at Rally, we've developed 200 factors that we derive from the SDGs when we look at investment opportunities from which we can evaluate the impact across the SDGs. And then finally, having that common language is really important. 60% of European companies today mention the SDGs. These are public companies, mention the SDGs in their reporting. About now 35% of US companies and 60% of Japanese companies. So it's going global. And by having that common language, and as an investor doing that common language, now we can have a dialogue about what it is that company is going to achieve. And when you see reporting on an investment portfolio, you'll understand the impact it delivers. One interesting, I would call it, shortfall of the SDGs is, while they're great at highlighting what the needs are of the world, they're not very prescriptive in terms of telling you, so where do I go to invest to address that need? And so what we need to do, and what we've done at Rally, as you see on the screen, is reorganize those SDGs into common areas or themes. Now, some of you may say, well, we were looking at the box of responsible investing before, and thematic investing is to the left of impact investing. That's true by categorization. So at Rally, when we talk about themes, we don't talk about it in the traditional sense. Most thematic funds that you would see out there, especially in public securities, are sector focused, right? You'd see a clean tech fund, a water fund, an agriculture fund, or maybe those sectors and target areas within one fund. When we talk about themes at Rally, we mean it from an impact perspective. So our themes are action oriented. What are we trying to achieve from an action through our businesses in order to affect change to the SDGs? And we use these themes to identify pockets of the market or the economy across the world where we want to make investments, so that we can map out value chains, and really understand where we want to direct our capital, so that we can identify companies and investments in there. The real key to understanding the benefit of your impact, of course, is your measurement. It's critical. And impact measurement is more than just showing, it's really about trying to address and talk about key questions. What changes are occurring as a result of your investment? When are they going to occur? Why are they occurring? Is it a direct result of your investment? Is it regulatory? And how's that change occurring? So all key questions when evaluating what your particular investment is doing to affect that change. And if you have great measurement and you know what's happening as a result of the impact your investments are generating, that of course becomes an important tool to mobilizing capital, getting people to invest in opportunities that benefit society and the environment. So digging into it a little more specifically from a Rally Assets perspective, what is it that we do to measure? What are we measuring exactly? And so it's really a few key areas. The first, I would say, is the most common amongst impact investors today, in both public and private markets, and that's revenue alignment. How do the products or services of a business affect the SDGs? Is it, for example, some healthcare technology that's going to improve healthcare outcomes? That would be an example. Of course, climate change. Is it a renewable energy product that's going to help reduce emissions? So revenue is sort of the common area today for impact. But at Rally, we kind of go deeper than that. We use the example of, if you had two solar companies and they were both manufacturing photocells, and I told you, well, one of the companies treats its employees terribly, or does something like, through its manufacturing, toxify its local environment and waterway, that's a problem. And so if you're only taking a revenue perspective for SDGs, you miss all that. And so we also look into the operations, or how a business conducts itself to generate its products and services. And so we look at alignment from both avenues. The third thing is what we've developed in-house at Rally is we have a transformation score. And what this is designed to do is evaluate the management, the policies of a company or a business, the constraints of its sector, the potential for change, and of course that intentionality. And grabbing those dimensions together, what we look to uncover is, yes, we're looking for good companies today, but we want to invest in companies that are going to continue changing and evolving themselves to create even greater impact in the future. And we call that sort of an underappreciated impact potential, or an impact alpha, that we're looking to capture through our investing. And we think that's an important area to measure, and then over time evaluate, did it come true? Did it actually happen? And then finally, an IMP assessment. IMP stands for the Impact Management Project. We look at that to understand the nature of the impact and the depth of what we're trying to uncover. So that can range from causes harm, which fortunately, of course, we don't invest in, avoiding harm, which is kind of more of a screening approach, but just not investing in bad areas, to benefiting stakeholders, which we mentioned is very much critical to impact investing. And of course, on the far end, contributing to solutions. And so for us, it's critical that the investments that we're making are actually achieving a combination of benefiting stakeholders and contributing to solutions. So we need to ensure that any investment we make through our measurement is creating that economic shift that's really needed to achieve those SDGs. So talk a little bit now about some of the key challenges we see in the industry, and some of the takeaways I'd like to leave you with. And this is really coming at it from a Canadian perspective within the impact sector. So, first and foremost, I think there's still a lot of misinformed perceptions out there. The biggest one probably being the return or the perceived risk of impact investments. That feeling of there's a concession of somehow that must be made in order to do an impact investment rather than a market return being available. It's just simply not true. And we think over time, as the evidence of impact investing and the track records form themselves, because it's still a relatively new area in the area of responsible investing, we think that's going to help dispel some of those areas of misperception. Greenwashing is a huge problem. You have different funds that label themselves different things, but there may be a holding in there that doesn't really resonate with a lot of people's impact goals. And despite the labeling and marketing on it, there's a lot of slick marketing. And so we think calling out greenwashing is going to happen more and more so. And in fact, the security regulators have flagged this as a major issue, not just in Canada, but across the world. And we've seen places like Europe take major steps to try to address some of the, let's call it falsehoods or not really representing products properly to clients. And so I think over time, it'll become more distinct what products are delivering what impact. Product availability and access has always been a challenge. And one of the reasons why at Rally we came out with our fund products wasn't because we were trying to sell funds. It's actually clients that came to us and said, can you make this? We need a genuine multi-asset class impact product and a global equities product. And so we developed that for them because frankly, when they looked around the market, they didn't see much of it, especially in Canada. That hopefully will change over time. We think that there's a lot of new managers coming up. They're relatively small, but we think they're going to be accessing that. And then finally, we have some measurement and reporting consistency as mentioned. I think that'll change over time. And scale, the whole size of the impact space will grow. And while that's a challenge today, we think that's going to address itself. And then finally, just some key takeaways I'd like everybody to leave with. One, impact investing is growing rapidly, and it's going to continue on that exponential growth rate, we think. Investors are continuing to look to move beyond ESG. ESG's table stakes now, and people are starting to really want more out of their investments. Favorable returns are achievable with impact. You can have great returns and a good portfolio. The UN SDGs are the language of choice when talking about impact. And we think finally in Canada, impact investing is going to become the new normal. So if any questions, this is our contact information up here. I'll shamelessly promote for the students in the crowd that Rally is hiring interns, and we do so regularly. And our deadline's coming up on January 16th. But please, if anybody has any questions, reach out or feel free to talk to me.
Great. Thank you very much, Mark. Great, insightful talk on some of the challenges with impact investments and on the opportunity in Canada and how it's growing. Do we have any questions for Mark right now? I can ask you one question. Sometimes, as you pointed out, sometimes people get confused between charitable investments or impact investments. And I guess it's important to draw out the distinction between impact and or concessionary investments versus non-concessionary investments. And you fall into the non-concessionary investment perspective, right? Is the problem nomenclature? Is it just how we name these things? Because it seems like there are variations of impact investments, and you really want to kind of delineate that there's a very distinct difference between impact investments that are seeking alpha or above market returns, and those that maybe are doing a concessionary play where truly there are certain what are deemed to be impact investments where someone will give a below market loan to a socially valuable institution or cause that they care about. Do you think that that's one of the problems? And is there a problem with linking that internationally? Because if you go to Europe, they have different naming requirements, or the United States and Canada is all kind of mixed up. Do you think we're going to clarify that, or is that a key problem for the future?
Yeah, I think so. I also think there's a little bit of a perspective difference. So impact has typically been more about the intention that one wants to create rather than labeling a product or an investment impact. And now those are becoming interchangeable. We do have clients that are interested and do invest in some concessionary opportunities, not in our funds. Those are all market rate based or better than market. But some of our management accounts are interested. And so what often happens is a client may come and say, look, there's an area of impact that's relatively nascent, and I want to provide some concessionary return capital for the purposes of helping to incubate and ultimately accelerate that area. And once it reaches a form of critical mass, now market returns are more possible. So sometimes it actually, the product and the driving towards concessionary returns is actually the intention, part of the impact intention of that organization or individual. They actually want to do that. It's different than charitable because they want it to be self-sustaining over time. But labeling that something different from a product perspective, rather than just using the blanket statement, I think would be very important.
Great. And also, you made another really important point about quantifying the impact of certain things. As you said previously, it was intentionality. Now we're moving to what have you really done for me? And so measuring the impact is, do you see the future being more linked between actual tangible effects of an investment? Like, for example, Goldman Sachs has a social impact bond, and part of their bond is we get paid out if we have this specific, if the crime rate drops below this level, we get paid out on our bond. Do you see more, investors holding impact investors to the fire? It's not just intentionality we care about now. We're facing big challenges in the world, and we want to know, in fact, that there has been a meaningful change in whatever the key metric is. Do you see that happening?
Yeah. I think especially in the fixed income world, you see an incentive structure is what you're talking about for some of the social and even at times green impact bonds, whereby the interest rate that a business would pay would decline if certain metrics are met. I would say, yes, I have to say often the product that's been out there has been disappointing, as in that concession is so de minimis that it hardly makes a difference to the issuer. And that's on the corporate side. Typically, if it's a government type of institution, that's almost built in, and there's a lot of intentionality there. But we've seen, bonds say, if we achieve the following, we'll drop the interest rate by 0.1%.
Mm-hmm.
Not very punitive. Something that's more progressive would be great. Also, on the question of data, which we really didn't talk about much, that becomes a key point. In climate change, there's a lot of data that's being flown around now, and we hear about scope 1, 2, and scope 3 emissions. And so there's a lot of tangibleness that can be evaluated. On the social side, such as, let's say, diversity and inclusion, it's still in its infancy what companies are collecting, measuring, and looking to achieve in terms of some targets. To do definitely when evaluating the impact or impact potential of an investment is not just take a pure data approach. You have to combine that with sort of a fundamental look at what the intentionality is, some of the softer points, and combine that with the data. The data should ultimately, once it's transpired, come forth so you can say, yes, it achieved what it was intended to achieve. But in an evaluation sense, if all you're doing is looking at data, you're kind of looking backwards all the time, as opposed to what a business is looking to do going forward. But that impact data is going to become more and more critical, and especially as standards get formed in terms of saying, you accomplished the following, what does that mean? Was there a systems change that was involved in that? And how do we actually evaluate that to see to what extent?
Great. And how do you see, my view a little bit has been that some ESG or sustainability and impact investors have been focused on easy asset classes because of the point that you make about data, that data is available in certain areas, whereas the harder areas tend to be in the private markets or in less liquid markets to look at. But as you say, some of these investments are very long-term and very forward-thinking. So, I mean, the irony is that we could be working with a kind of a model of investments that doesn't work to meet our long-term goals, that are short-term thinking in equities may not yield us what we want to achieve in terms of long-term infrastructure change. How do you see that kind of moving forward in the way that that is meaningful to achieve our larger goals? I just worry that we're going to make all the right moves short term, and we're going to lose sight of our long-term goal that in 2080 we want to have achieved these changes in whatever environmental or social or governance aspects. And is there a danger that we miss out on the long-term goal by exclusively focusing on assets that are kind of by their nature shorter term, predominantly equities, I guess I would say?
Yeah, I think that's a great question, because it's a very valid point. If everybody crowded all their investments into the same areas, such as electric vehicles, for example, but ignored everything else that had a cause or was part of the system of climate change, we're not going to fix the problem at all. And so sort of the hot money kind of going to what's popular, or sometimes that translates into momentum stocks, and we're certainly very cognizant of that. And we like to take the approach of systems change, and that's when one has to look at what is it about a system, what are the different pillars in that system that we need to put capital towards to actually make the outcome be what we want. And that approach, I think, is very critical. We have investments that look at, and I'm thinking of some of the private investments that we've made, where the funds that we've invested in are actually specifically looking for the less sexy areas of climate, right? Like not the hydrogen, not the electric vehicles, not the renewable panels. How about things such as different ways of creating alternatives to meat products? Or how about different ways of fueling ships, or different ways of thinking about logistics management, or different ways of thinking about consumption? And so all those things need to change, because there's a carbon footprint across almost everything that we do. And if you don't change all these pillars of the system, you're actually not going to achieve that thinking change in systems. So I'd say it's very paramount. I think as investors become more educated, more aware about what their dollars are doing, and that's starting to be questioned right now. There's been a lot of talk about, well, we're piling all this money into ESG and responsible products, but we're not getting the change that we want. We're not seeing it. The world's still heading in the wrong direction. Those questions, and I'd say, kudos to the younger folks, because that's often where the source of the questions are. Really understanding what it is they're consuming and buying, and what those companies are doing. I think that that's going to be a key critical area. And I'll touch on the other point that you mentioned about businesses sort of in the hot areas. There's a lot more data to sink your teeth in. That's true. There's also a size bias, where you can go onto a company's website, they get a chance to put together an ESG report that's quite flashy. They have a big budget. They start pointing out all these SDGs that they look at, and they'll cite a few points to it. And we kind of refer to that as SDG bingo when they're self-identifying. You need to be a bit skeptical and really evaluate that. You can look at the numbers, but you need to look at the change, the intentionality, and really take that forward-looking view to go, is this real, or is this just kind of painting it up a little bit?
Marc, great talk. Thank you very much for your support, for contributing, and I wish you continued success. What we're going to do now is take a 15-minute break. For those of you who I can see that there are many questions for Marc. We're going to break up into breakout rooms. For those of you who want to go and get a coffee, please feel free to take a break. At now until 10:45, when we are going to have Professor Cleary come and talk to us about his views on the future, and where we get to with the help of the Sustainable Finance, Sustainable Institute for Sustainable Finance, and going from there. So with that, we are going to open up the breakout room. So please bring your questions and talk to Marc, as well as I believe Bruce Lowry is still here. And we thank you both for insightful, thoughtful presentations so far. So I'm going to be quiet now. Please enjoy a break, or if you want to talk to Marc or Bruce, please use the breakout rooms. You can select and you can move between them or come back to that. But we will return at 10:45 with Professor Sean Cleary from the Institute of Sustainable Finance, and who is also a full professor at Queen's University. And we'll go from there. So thank you very much. And thank you again, Marc and Bruce, for great presentations.